All right, let's talk about Bluebird Corporation. You know, the iconic American school bus company. We're going to break down what's going on with them using a fantastic deep dive research report from Compasscope and mixing in the very latest numbers from their Q3 earnings call to give you the full picture.
So here's the game plan. We'll start with what the company actually does, then see how they stack up against the competition. After that, we'll look at their big growth plan and, of course, the potential risks. We'll wrap it all up with their most recent performance and what to keep an eye on going forward.
First things first, what is Bluebird, really? It's way more than just that classic yellow school bus you remember from back in the day. The Compasscope report breaks their business down into four main parts. You've got their bread and butter, the big Type C and D school buses. Then there are the smaller buses they make through joint venture. They also have a growing business selling aftermarket parts. And get this, they're launching a whole new commercial vehicle platform in 2026. But here's where it gets really interesting. Their push into alternative fuels is just massive. In their last quarter, a huge 61% of the buses they sold were not diesel. We're talking propane and electric. And this isn't some new fad for them. They've been leading this charge for over 15 years. Okay, so they're a leader in alternative power. That's great. But what does that actually mean in a super competitive market? Let's take a look at how they really stack up against their rivals. You know, when you look at the analysis, you see this classic trade-off. Their intense focus on alternative fuels is a huge strength, but it's also a vulnerability. It means they're really dependent on government policies and subsidies, and they're more exposed to tariffs than their rivals, who are part of these giant truck manufacturing companies. And this table just lays it all out perfectly. You've got Bluebird, the specialist with that first mover advantage in alt fuels. And then you have the heavyweights, IC Bus, owned by Navistar, and Thomas Built, part of Daimler Truck. They're leveraging the massive scale and deep, deep pockets of their parent companies. So what's the bottom line? Well, Compasscope puts it perfectly. Despite all that heavyweight competition, Bluebird's position in alternative fuels isn't just strong. The report calls it the most defensible in the entire market. That one word says a lot.
All right, so we know where they are now. Let's talk about where they're trying to go. The company has laid out a really clear four-part growth strategy. It's a pretty straightforward plan. 1, build more stuff, including a huge new facility just for EVs. 2, sell more stuff, targeting over 12,000 buses. 3, double down and scale up their leadership in electric buses. And 4, get more efficient to make more money. So what's the big, audacious goal at the end of all this? A $2 billion revenue target. Yeah, you heard that right. $2 billion. That would be a huge leap from where they are today, and it's basically the North Star for this whole plan. But look, they're not just chasing sales. This is about profitable growth. They're aiming for a best-in-class adjusted EBITDA margin of over 16%. If they can hit that number, wow, that signals incredible efficiency and would put them right at the top of the industry. But hey, no plan like this is ever a sure thing, right? There are always going to be some bumps in the road. The research also pointed out several potential roadblocks that could make this journey a bit tricky. So what could actually throw a wrench in the works here? Well, funny enough, the biggest risks aren't really about Bluebird's own execution. They're external, and they're mostly driven by policy. The major hurdles are potential delays in government money. We're talking about the grant for their new factory, and maybe even more importantly, the EPA funding their customers depend on to actually buy these new EV buses. Throw in the uncertainty from tariffs, and those are your main challenges. But, and this is a big but, let's put these risks in perspective. Every company in this space has risks, and the Compasscope report, it actually rates Bluebird's execution risk as moderate, which is notably lower than several of their competitors. I mean, when you see a company like Lion Electric rated as severe, it really highlights the relative stability of Bluebird's position. Okay, enough with the big picture strategy. Let's get down to the brass tacks. How are they doing right now? Let's pull some key numbers directly from their latest Q3 earnings call. So how'd they do? Well, in the third quarter, they posted a record $398 million in revenue. And this is the 11th straight quarter that they've beaten their own financial guidance. Think about that consistency for a second. That's a remarkable track record. And it's not just about the top-line revenue. They also hit a record adjusted EBITDA margin of 14.7%. Now, why does that matter? Because profitability is the engine that funds the future.
This is the cash flow that's going to pay for those new factories and the R&D on the next generation of buses. And what about that all-important EV story? The momentum is undeniable. They sold a record 271 electric buses in this one quarter alone. This isn't just a number, it's tangible proof that their biggest strategic bet is paying off right now.
Now, it wasn't all perfect news. The company did see its order backlog dip a bit, which they said was due to tariff uncertainty, but the CEO was very direct on the earnings call. He framed this as a temporary pause by customers, not a long-term structural problem. It's like passengers just holding on tight for a moment during some turbulence. Okay, so we've looked at the business, the competition, the plan, the risks, and the latest numbers. So what does this all mean for the road ahead? Let's boil it all down to the key things you should really be watching.
The Compass Scope report really nails it down to these 4 areas. It basically all comes down to government funding, trade policy, whether those customer orders bounce back like the CEO thinks they will, and critically, whether they can keep making good money on EVs as they sell more and more of them. So, in the end, you've got a clear leader in a transforming industry. They have a solid strategy to capitalize on that shift, but their fate is uniquely tied to these big external forces. So the defining question really is this: is their strategic advantage and market leadership strong enough to navigate the turbulence of government policy and win this race?